Welcome back to FT Markets. We're looking today at an unintended, perhaps negative consequence of quantitative easing in Europe. Low interest rates, of course, great news for borrowers, but for those preparing to pay Europe's pensioners of the future, they create all sorts of distortions in company pension schemes, which are emerging as perhaps one of the victims of central bank action. With me to discuss what this means for financial markets is Paul Waters, who's head of corporate credit research at Standard & Poor's. Paul, welcome to the Financial Times. Company pension schemes, not always the easiest things for people to understand, but tell me, just why are market interest rates so important to the pension provisions of the future?
Well, I mean, the key thing here is that actually there are a lot of assumptions that go into the calculation of what pension sort of scheme liabilities actually should be. And two of these most important assumptions are actuarial assumptions around the level of long-term interest rates, which is what you need to discount the future liabilities, how much you have to pay, and also what your future long-term inflation expectation assumptions actually are. So those are two key assumptions.
Let's look at those interest rates, the discount rates that are used by pension funds. You brought along an interesting chart here showing, well, tell us, what are we showing here? These are for German and French pension funds.
Okay, well, what we have here, the key one to look at really is the green line, which shows the long-term AA corporate bond index in the euro area. And you can see that it's collapsed. It's basically been collapsing in recent years, and of course it's got it's sort of fallen substantially further after QE was introduced this year. So it's got down to about as low as 1.1%. And the blue and the red lines are the average discount rates that French and German schemes use.
And if interest rates are falling, if discount rates used by the pension funds are falling, that means that their liabilities are so much greater in the future.
Absolutely.
Let's look at the second chart, which shows the scale of the problem. We have obligations of we're looking just defined benefit here. This is where the problem's focused, presumably.
Yeah, I mean, because of falling interest rates, the present value of future obligations, which is the liability of the pension fund, is increasing substantially, and of course so what are the returns? What are the plan assets that match that? Yeah. Now you can see here in this chart that actually there's a substantially lower level of funding, particularly in Germany and France. So that's, compared to the UK and the Netherlands, which is the green line. So then you've got to say, well, okay, so what are the return on plan assets? What's the asset allocation, and what contributions can the company make?
These are defined benefit where companies made promises about future pensions, essentially.
Absolutely.
So what are the solutions? How can we get out of these difficulties? I mean, we've had a number of instances already in Germany. Lufthansa recently admitted to quite serious problems in their pension schemes, which they need to sort out with unions. What are the solutions?
Well, I mean, risk management is because companies can't obviously control the actuarial assumptions which are being made for accounting reasons. So they have to actually adopt measures to mitigate the risk. So that means trying to reduce benefits, or closing schemes, or trying to sort of sell off the risk to third parties. And
what does it mean then for credit ratings? Are you going to be downgrading a lot of European companies because of these sorts of problems?
Well, for us, the level of underfunding on the defined benefit scheme pensions funds, we incorporate that into our measure of adjusted debt. So that is one factor that feeds into our financial risk assessment. But we recognise that this is a long tail. I mean, the duration of these funds is 20 years. The assumptions can be very volatile, but ultimately these liabilities have to be paid.
This is, Paul, a last question. This is something that falls into the category of something that we don't have to worry about too much right now, but long term it could be a much more significant problem.
Well, that's correct, but obviously it depends on the regulatory environment and the country in which the company operates, because there can be requirements to actually, trustees may want to have a 3-year recovery plan or to put in place a recovery plan over perhaps a slightly longer period. As in the UK with BT, for instance, every 3 years they have a discussion with trustees to actually address the issue.
Okay, Paul, I think we'll have to stop there. Paul, thank you very much. So some problems emerging then for European companies already could become more serious.